If you make over $400,000 per year, then your tax bill is somewhere between $120,000 to $150,000 per year, or $300 to $400 per day. And that's insane, because that's the equivalent of going to the Apple store, buying a $300 to $400 iPad mini, taking that thing home and smashing it every day. What's even crazier is if you're making between $600,000 to $1 million per year, your tax bill is probably closer to $200,000 to $350,000 per year, or somewhere between $600 to $1,100 per day, which is the equivalent of going to the Apple store, buying a MacBook Air, and smashing it in front of your family every single day. Well, the good news is there's an easier way to wipe that tax bill and bring it as close to zero as possible with what we call short-term rentals, or Airbnbs, using the golden rule ratio. Now, let me explain. So the way the tax stuff works is when you buy real estate and specifically use it as a short-term rental or an Airbnb, you're allowed to take this thing called bonus depreciation, which is this portion of the purchase that you're allowed to accelerate as depreciation year one. So an example would be, let's say you buy $1 million home and the bonus depreciation on this home comes back at around, let's say 25 to 30%, or let's say $300,000 of the total purchase price. What this essentially means is you're allowed to take a reduction in your total adjusted gross income by $300,000, effectively reducing your total taxable income by $300,000. And that reduction means, let's say, for example, you were making $600,000 a year and you dropped your income from $600,000 by a factor of 300,000 all the way down to 300,000, your net effective tax savings would essentially be close to hundreds of thousands of dollars. And this is the exact strategy hundreds of our clients use every single year to buy cash flowing real estate, specifically cash flowing short-term rental Airbnbs that are already live, already pre-furnished, already as close to turnkey as you can possibly get. And we help them find and negotiate those deals so that they can close on those homes and get the tax benefit. But here is the one thing that 99% of those people who don't work with us fail to understand, and this is what they get wrong. So they're buying Airbnbs and they're able to wipe out their tax bills, but there's one issue. They're doing it the old way. The old way is to use what's called conventional financing or traditional financing. This means getting a loan for that, let's say, $1 million home and putting down 20 or 25%, which is close to $200,000 or $250,000 in this example. And what's even worse is they're not only putting down a super heavy down payment, they're also incurring insane closing costs that are a portion of what they pay a lender or a mortgage company for a loan origination fee or broker fee, and something called a rate buy down. If you want to shave a 1/4 point or a 0.5% or a percentage off your interest rate, you need to prepay that in advance. So the real problem is, yes, these people are still buying Airbnbs and getting massive tax benefits, but the problem is they're paying way more on their down payment and closing costs than what they should be versus doing the golden ratio method. The golden ratio method when buying short-term rentals specifically means buying Airbnbs for the tax benefits, but using the lowest possible down payment amount, closer to like 6 to 10%. So on $1 million home, closer to $60,000 to $100,000 down, instead of the old way with conventional financing, which requires you to put down at least $200,000 to $250,000, or 20 to 25% of this $1 million home example. And that means you are literally spending $70,000 to $200,000 plus more on your down payment and closing costs than you would be if you did it the new way using the golden ratio method. And the one thing that makes this golden ratio method possible is what we call seller financing. Seller financing is a way of purchasing Airbnb properties, specifically working with sellers who are very comfortable taking exceptionally small, low down payments today in exchange for you financing the property with them, meaning the seller becomes the bank and they make monthly payments instead of you using a brand new mortgage company. So why in the world would a seller do this? Well, it's pretty crazy. They really have no other option. It's true. For sellers who've owned their homes for, let's say, 5, 10, 15, 20 plus years, they've incurred massive gains on the home, meaning the home has gone way up in value over time, which is phenomenal. But the problem is there's one thing that they need to pay off when they sell the home and they get all their proceeds in cash. If somebody were to be a traditional or conventional buyer and pay them all that money today, they get hit with this thing called capital gains tax. So what they don't want to do is lose a massive amount of their gains on their property to capital gains tax the moment that they sell the home. So instead, what they need to do is take a little bit of today money, which means they need to take a really low down payment today, which is great for you, the buyer. In exchange, they seller finance the home to you, where you, the buyer, make payments to the seller instead of going and making payments to the bank. And the trade-off is the seller gets a little more on purchase price, which is okay, because the golden ratio method pretty much means you're putting down almost less money than what your net effective tax savings is by the time you close on this home, get what's called a cost segregation study, give it to your CPA when they prep your returns. And the golden ratio is pretty much putting in as low money down plus your cash to close and having a net effective tax savings that is right at or almost above what you actually put in as a down payment and closing costs into the property. Now, I know that's a lot to throw at you in this really short video, but we as a company, My BnB Accelerator, help hundreds of clients do this every single year, and now hundreds of repeat clients who do the same thing every single year. They're making $400,000, $600,000, $1 million as a household income between them and their spouse, and every single year they dump money into real estate using the golden ratio method, which is super low money down, seller finance payments, and in exchange for that, they get what's called bonus depreciation, that thing that allows them to reduce their total taxable income, and they save hundreds of thousands of dollars every single year in two ways. The first way is obviously the bonus depreciation, wiping out their tax bill or getting it down as close to zero as possible and doing it all legally. And the second thing is they literally save $70,000 to $240,000 or more on the average down payment they make. So you have two options here. If you've decided that you're going to do real estate this year, you can basically do it the old way, which is basically overpaying on your down payment by $70,000 to $240,000. Now, if you have an extra $70,000 to $240,000 laying around, more power to you. But if you want to do it the new way, using the golden ratio method, which is literally using the lowest down payment possible, using seller finance terms, so that you can take the maximum bonus depreciation possible and have this crazy ratio where your money into the deal is almost less than the net effective tax savings that you get out of this, you are playing something close to an infinite money glitch game, where instead of wasting away hundreds of thousands of dollars per year on your tax bill that you just wave bye-bye to and go to the Apple store every day and smash a MacBook or an iPad mini, which is chaos. This is insane to me. If you want to be part of the new way of doing real estate and do this every single year so that you're building a portfolio of real estate for you to retire on and accelerate the timeline on which you're retiring much faster than simply wasting away hundreds of thousands of dollars every single year on your tax bill, click the link somewhere around this video and you're going to be on a page where you'll see examples of us doing this for clients who come back to us and do this again and again and again, year over year. So if you're ready to get into real estate with short-term rentals so you can wipe out your tax bill, click the link somewhere around this video and we'll show you exactly how it's done.